Good afternoon. We'll take up today units 7, that is logistic and supply management. Logistic happens to be the important component of any, say, operation management work. So today we'll talk of what is logistics and what are the costs associated with. How to manage the cost is a challenge before all the supply chain managers or logistic managers. Now, to start with, logistical cost refers to any expenses incurred by a business to manage its logistics. That means logistical costs are those costs which are to associated with the, say, management of logistics, and every organization, small or big, has to incur some logistical cost. Knowing how to reduce them is a key to being more competitive. And logistic cost include your expenses related to resource acquisition, product distribution, and other expenses that make up the company chain of production, sales, and delivery. Now, logistics cost include expenses related to resource acquisitions, product distribution, and other expenses. Good management of logistic costs go beyond the making of product reach the consumer. It includes decision making on how to use financial resources best, and of course, ensuring savings in all these procedures. Now, talking about logistic cost, acquisition cost is one of the important component of, say, logistic cost. It includes the purchase of raw materials and other inputs required to produce the goods that will be delivered to the consumers. Inventory is another main logistic cost of an organization, and inventory cost includes the cost of storing the products and expenses of storing the products. And today's world is very competitive. Packaging plays an important role to attract the customers. Generally, business attract the customers by attractive package. When sending goods to distance areas, or when items are fragile or like glass items, it needs protection, and to arrive at their destination undamaged and the customers are satisfied, packaging is an important cost of any logistic management. And another cost of logistic is transportation cost. Transportation logistic costs are related to distribution of product. These expenses include fuel, tolls, hiring drivers or a partner company, and sometimes taxation is also a part of the, say, logistic cost. Investment in new technology is also a important logistic cost, and people who work in the logistic department or in the supply chain department, their salaries, their vacation, their all types of benefit, their cost on their children's educations, all these are constitute the logistical cost. The cost of satisfying the consumer demand can be significant, yet surprisingly, they are not always fully understood by the organization. One of the reasons is the traditional accounting system focused on, say, understanding the product cost rather than, say, controlling the cost. Logistic activity requires resources in the form of fixed capital and working capital, and there are financial issues to be considered while supply chain strategies are devised. Logistic management is a flow-oriented concept with the objective of integrating resources across pipeline which extends from suppliers to final customers. It is desirable to have a means whereby cost and performance of that pipeline can be assessed. Logistic costs are the result of the process that begins with the supply of raw materials and ends with delivery of the products to the customers. And this involves the main logistic operations such as supply, physical conversions, and distribution. Now, the discussion show that the cost of satisfying the consumer demand can be significant, but surprisingly many organizations fails to understand its importance. Now, another thing is logistic management is a flow-oriented concept with the objectives of integrating the resources across the pipeline, which extends from suppliers to final customers. Now, talking about the logistic cost, we have an important concept of total logistic cost. The total cost concept consists of designing of logistic as an integrated performance system, and it highlights on accounting methods. The accounting methods are your say balance sheet and profit and loss account. Balance sheet reflects the financial position of the firm at a specific point and in time, while is purposed to summarize the assets and liabilities and to indicate the net worth of the ownership. Financial statement flow generally say accepted the accounting practices designed to meet the requirements of the investors and taxation agencies of the central, state, and local government. The practice of say grouping expenses into specific accounts such as salaries, rent, depreciation fail to identify or assign operation responsibility. Logistic performance evaluation, it becomes necessary to identify the cost associated with performing specific logistics activity or task such as the warehousing expenses for specific SKU. Then deficiency of traditional accounting, progressive procurement procedures require that expenses for all service industries, transporters are identified separately from purchase cost to evaluation purposes. So, to start with the introduction, sometimes a company is unable to make sufficient profits despite of having a good range of product or better services or even significant number of satisfied customers. There are several factors to which this shortfall may be attributed, like insignificant sales, poor economic conditions, tough competition, but a major reason is lack of possible losses. But a major reason is lack of knowledge of possible losses. It is therefore important to evaluate the true cost of a cost object, product, job, and service or customer. So this introduction says that many companies have good products, wonderful products. They have a satisfied customers and even significant, and despite good range of, there are several factors which may be attributed to like insignificant sales, poor economic conditions, there may be tough condition. But major reason is that business failed to understand what is the why there is a loss. They are important to evaluate the true cost of a cost project, product, job, service, and customer. Now, logistic cost, as I already told you, refers to the expenses incurred in the process of planning, implementing and controlling the efficient flow and storage of goods, services, related information from the point of origin to the point of consumption. These costs play a crucial role in supply chain management and can significantly impact a company's profitability. Logistic costs encompass various elements, and understanding and optimizing them are essential for business to remain competitive. So, we'll discuss what are the key components of logistic cost. I've already discussed acquisition cost. I've already discussed acquisition cost is acquiring the raw materials of the company. Then there is, say, inventory transportation cost. This includes expenses associated with moving goods from one location to another. It involves costs related to shipping, trucking, air freight, rail, ocean freight, and other modes of transportation. And another important key element of logistic cost is inventory carrying cost. This includes costs associated with holding and managing inventory, such as storage, insurance, taxes, opportunity cost of tying of capital in inventory. Opportunity cost means suppose we have kept 1 crore of raw materials in our, then this 1 crore rupees is tied up in our inventory that could have been used in some other purpose. Otherwise, this 1 crore would have earned some interest if I simply keep this money in a bank as a fixed deposit. Warehousing cost, expenses related to storage of goods, including rent or mortgage of warehouse space, labor cost, equipment, utilities, and maintenance. And there is order processing cost. These costs involve the expenses associated with order fulfillment, including order entry, picking, packing, and other documentations. And information communication technology, ICT cost, investment in technology for managing and optimizing logistic processes, such as transportation management system, warehouse management system, and communication tools. Cost associated with imports and export compliance, including custom duties, taxes, and fees. Then I've already told you packaging cost, expenses related to materials and labor required for packaging goods for transportation, storage, and handling. Packaging cost is really significant when products are fragile in nature, and it requires a good packaging while it should not be damaged while it is on transit. If the goods are damaged during transit due to its fragile nature, it may be a great loss to the organization. Therefore, business take a lot of care in packaging these fragile products, where that the goods may not be damaged during the transit period and the customers will not be dissatisfied. Cost associated with losses, damages, and theft during transportation, warehousing, and handling. This is always there whenever you say store certain materials in the inventory. Suppose there is cost associated loss, there is some natural calamities, there may be flood, there may be earthquake, there may be cyclone. In that process, certain items may be lost and damaged and proliferation. There is also theft during transportations, warehousing, and handling. Then expenses related to management of product returns, recycling, or disposal of unsold or obsolete inventory. Sometimes goods which do not satisfy the consumers, they like to say return the products and have a new or a fresh product in place of that, which also cost to the organization. That is called reverse logistic cost. Risk management cost associated with mitigating and managing risk in the supply chain. such as insurance and premium. In supply chain, there may be, so suppose in transit the truck may get, or there may be some accident, or some materials may be damaged. So all business organizations insure their products in case of loss, which will, the insurance, they have to pay premium, and the insurance will mitigate and manage the risk in the supply chain. Effective logistic cost management involves optimizing each level of these components to achieve a balance between cost and service level. This optimization is crucial for businesses to enhance efficiency, improve customer satisfaction, and remain competitive in their marketplace. Now, total cost analysis in the logistic is a comprehensive approach to evaluating all costs associated with the movement and storage of goods. The goal of TCA is to identify and quantify all costs related to the logistic activities, allowing the businesses to make informed decisions and optimize their supply chain operations. Here are the key steps and elements involved in. So, before I go to the keys, elements, now total cost analysis in logistics is a comprehensive, it's a very detailed approach to evaluating all costs associated with the movements and storage of goods within a supply chain. The goal of TCA is to identify and quantify all costs related to whatever type of cost, starting from acquisition cost, starting from your transportation cost, packaging cost, risk cost, all types of cost has to be identified and quantified to logistic activities, allowing the businessmen to make informed decisions and optimize their supply chain operations. Now, we'll go to the key steps. Identify the cost components. First is, the cost component is classified into two categories. One is direct cost and indirect cost. Direct costs are those costs which are directly associated with physical movement and storage of goods. I have given an example: transportation cost, warehousing cost, and packaging cost. These costs are directly associated with physical movement. When, say, materials move from one place to another, when we store certain goods, we have transportation cost, warehousing cost, you can electricity bill, salary of the guard or salary of the storekeeper, packaging cost. All these costs are direct cost. Indirect cost are sometimes hidden cost. They are not, say, apparent immediately. Examples: order processing cost, inventory carrying cost, cost associated with stockouts or overstock situations. Now I will give you the last one, this cost associated with stockouts. Now, what are the indirect costs associated with these stockouts? That will say bring bad name to the organizations. The goodwill of the organizations will go down if there is a stockouts in the finished product. If it is stockout in the, say, raw material, your production will be halted, and overstock situation is also brings a great loss to the organizations, because items remain unsold, and in case of, say, raw materials, the inventory costs are stock up. Now, so first is identify the cost components. Cost component: direct cost, indirect cost. Gather data, collect data on relevant cost. So both direct and indirect, they may involve collaboration with different departments within the organizations, as well as external partners such as suppliers, carriers, and third-party logistic providers. And categorize the cost. After gathering the data, you classify the group cost into categories to facilitate analysis. For example, cost can be categorized as transportation cost, inventory cost, order fulfillment cost, and so on. Then allocate cost to specific product or service or customer segment. This helps in understanding the true cost associated with each element of the supply chain. Then sum up all the cost associated with the logistic activities to get a comprehensive view of the total logistic cost. This includes both variable and fixed cost. Then evaluate cost drivers, identify the key factors or variables that drive logistic cost. For example, transportation cost may be influenced by factors like distance, mode of transport, and shipment value. So, key factors or variables that drive the, suppose an example, the longer the distance, the more will be your transportation cost. A mode of transportation, air transport is always costlier than the road transport. And shipment volume, if your shipment volume is very large, then your transportation cost is, then compare alternative, analyze different logistic strategies, transportation mode, and supply chain configurations to determine their impact on total cost. This may involve scenario analysis to assess the cost complication of the various decisions. Then after you evaluate the cost drivers, cost driver means what are the factors responsible for, say, incurring the cost. Then we make a compare the alternatives and we analyze different logistic strategy, transportation modes, and supply chain configuration to determine their impact on the total cost. Consider the trade-offs. Recognize that there may be trade-offs between different cost components. For instance, reducing transportation cost may lead to increase in inventory carrying cost. Yes. If you send less product to the distributors, then if you reduce the transportation cost, then our inventory carrying cost may increase. Continuous improvements is not a one-time process. Regularly review and update cost analysis to account for changes in the business environment, market conditions, or internal process. Continuous improvement is essential for adapting to evolving supply chain dynamics. By conducting a total cost analysis in logistics, businesses can gain a holistic understanding of their supply chain cost and make strategic decisions to optimize efficiency, improve customer service, enhance overall competitiveness in the market. Cost drivers and activity-based costing are an important concept in logistic management that help organizations to understand and allocate cost more accurately. Now, we have discussed the total cost approach. Now we will discuss the activity-based costing. Now, cost drivers are the factors that directly influence the cost of an activities. Identifying and understanding these drivers is crucial for effective cost management. That means I've already told you who are the cost drivers. Cost drivers are generally the factors who are directly influence the cost of an activity. Whether the cost will be more or cost will be less depends on these factors. Identifying and understanding these drivers is crucial for effective cost management in logistics. Examples in logistics: volume, the amount of goods being transportation or processed affect cost. Higher volume will lead to increased cost for transportation, handling, and storage. These are the example I have cited. If you send more goods, if you transport more goods, naturally the transportation cost and the handling cost and storage cost will be high. Transportation costs are often driven by distance goods need to travel. Longer distance generally results in higher transportation cost. For example, if you send materials from Delhi to say Bhubaneswar or Delhi to say Hyderabad, and in domestic, it is domestic transportation. Suppose if you send material from say Delhi to from a foreign country, say to Tokyo or to say to for that purpose to Dubai, then your transportation cost will be naturally, because your where distance is high. Second, your mode of transportation is also changing. In a domestic, you can send by say by train or by say railway services, but in case of say international transport, you have to depend on your air fees or air mode or shipping or water transportation. Then some logistic costs as shipping charges may be influenced the weight of the goods being transported. If the higher weightage goods are to be transported, then it requires more people to load and unload, isn't it? Technology may be also be some machinery and technology can be like cranes can be used to lift the product and load the products in the say truck or in the say railway wagon. It may also say cost a lot to the organization. Time sensitivity. That means this is also an important factor. What is time sensitivity? Suppose you want a customer wants to send a material or wants the materials to be sent immediately and it should be reached within 2 working days. And the urgent deliveries or time sensitivity is called urgent deliveries or time sensitivity shipments may incur additional cost for expedited shipping and special handling. Now, this is all applicable in courier services. Some courier services they charge higher say logistic cost because if they want to deliver the material within 24 hours. Then also we go to our say post office services like the speed post service. Speed post service, they deliver the products within 24 hours, but they charge a higher cost for that. Handling requirements, special handling such as temperature control transportation or delicate item handling can drive up cost. Special handling, certain products such as which require glass products or fragile product, they require special handling such as temperature control transportations. Suppose you are sending perishable products like fish or some seafoods to the foreign country, you have to take in a particular temperature so that there may not be damage, and delicate item handling can drive up the cost. Now, I have given certain order generations and cost drivers number of. Now the order generation depends on number of orders received, isn't it? Now if the number of orders received is more, then order generations are more, then the number of costs depends on the number of orders received. Now activities are order entry. Now, the cost drivers are number of order process. If number of order process are more, the cost drivers, the logistic cost will be more. Inventory checking. Now, if you check more inventory, then the cost of logistics will be high. And if the inventory checking is less, now these are all inversely related. Now, credit check, number of customer accounts. If you check more, accounts, then the credit checking cost will be higher. Now, number of order process, back order. What is back order? The order which were not able to supply in the previous order. So, that also depends on the number of order process. Acknowledgement, number of picking documents. If you are picking more documents, then you have to give more acknowledgement. Generate picking instruction, number of invoices, you have depend. Invoicing, number of items per invoice, and payment processing, number of checks, etc. Credit adjustment, number of credits. So these are the general activities and these are the cost driver. The left hand side shows what are the activities generally there in a logistics operations and what are the cost drivers of that activities. Now, cost pool marketing, activity promotion and advertising, cost driver, number of inquiry, number of sales calls, all these are the cost drivers. Then application in logistics, break down the logistic process into specific activities such as order processing, transportation, warehousing, and inventory management. Now, we will come to an important concept, activity-based costing. Activity-based costing is a costing methodology that allocates cost to specific activity based on their actual consumption of resources. It provides a more accurate reflection of true cost of products or services by identifying and assigning cost to the activities that drive them. So, what is activity cost? It's a methodology that allocates cost to specific activity. Now, how do you allocate it? It is based on the actual consumption of resources. How much resources that activity is consuming. On that basis, we allocate cost to the specific. It provides more accurate reflection. The who provide the activity-based costing provides a more accurate reflection of the true cost of the product or services by identifying and assigning cost to the activity that drive them. Then why it is more accurate? Because it we identify and assign the cost to the activity that drive them. Yes. Assigning determine the direct and indirect cost associated with each activities. Direct costs are easily traceable, while indirect costs may be, say, allocated based on relevant drivers. So, as I discussed, so what is the direct cost? I discussed here. Yes. Direct cost, I discussed here. These are costs directly associated with the physical movements. And indirect costs are hidden costs. Indirect costs are the hidden costs. They are not immediately, say, apparent. They are not immediately identifiable. But they also plays an important role in, say, logistic. So, ABC is a costing methodology where you allocate cost to specific activity based on their actual consumptions of resources. It provides a more accurate reflection of true cost of the product or services. Now, determine the direct and indirect cost associated with each activity. Direct cost is easily traceable, while indirect cost may be allocated based on relevant drivers. Allocating cost to the product, once the costs are assigned to the activities, they can be allocated to specific product or services based on the use of each activity. This provides a more accurate understanding of the cost structure. In logistics, ABC may reveal that certain products with unique handling requirements or specific transportation needs incur higher costs due to the activity associated with meeting those requirements. Now, what are the primary activities? Product and service customization, design and development, specific services, specific equipment, cost allocated to specific customer. So these are the primary activities. Product service customization, that means for each, say, customer, we make the product service customized according to his requirement. Design and develop the activities and specific services to specific customers, specific equipments for specific, then we have to allocate the cost to the specific customer. Now, customer profit analysis is a process where business evaluate the profitability of individual customer or customer segment. This goal is to understand the financial impact that each customer has on the company's overall profitability. By analyzing customer profitability, businesses can make informed decisions about resource allocation, making strategies, and customer relationship management. Here are the key steps and consideration in conducting customer profit analysis. So, what is customer profit analysis? Is a process where business evaluate the profitability. So, the analysis say that each and all the customers are not equally important to the customer, to the organization, to the business. So the goal of this analysis is to understand the financial impact that each customer has on the company's overall profitability. Suppose X is a customer, Y is a customer. If X stops purchasing or taking our product, so what is impact on our organization? If Y stops using, what impact is on the organization? By analyzing the customer profitability, business make informed decision about the resource allocation. So here in a customer profit analysis, they study which segment of customers give more profit to the organization vis-a-vis the other segment. Accordingly, the companies can make informed decisions about resource allocation. That means they will allocate resources differently to different segment of customers, and they will adopt different market strategies for different segment of customers, and they will adopt different customer relationship management for different segment of. Here are the key steps and considerations. Now, first we have to gather data, collect data on revenue generated by each customer or customer segment. This includes sales volume, transaction frequency, pricing structure of the product and services. Very important data. Now, we have to collect data, revenue generated by each customer or customer segment. So, this includes a particular segment of customer, what is their sales volume in a particular month or in a year. Transaction frequency, how frequently they purchase you, every month or every day. Every day may not be, every month or weekly, or say by bi-monthly or 6 months or in a year. So pricing, what type, are they purchasing costly product or services, or they are low volume product and services from you? Now, then assign both direct and indirect cost to each customer or customer segment. Direct cost may include production cost, distribution cost and other expenses related to servicing a specific customers. Indirect costs such as overhead and administrative expenses should also be considered. So the first step is gather data, and in gather data, we have to gather data. So what is the revenue generated by each customer or customer segment? Then we have to allocate the cost, and here we have to assign both direct and indirect cost to each customer segment. Direct cost, I have given you example, production cost, distribution cost and other expenses. Then calculate customer profitability. Subtract the allocated cost from the revenue generated by each customer. So calculate the net profit associated. This provides a clear picture of the contribution. So the profit is calculated is subtract the allocated revenue minus allocated cost gives you the net profit. This provides a clear picture of the contribution of each customer to the company's bottom line. Group customer into segment based on similarities in purchasing behavior, needs and demographics. This segment helps to identify the patterns in customer profitability and allows for more targeted strategy. So group the customer into segment based on similarities. The customer buying similar products, they are grouped together. Customers having similar needs are grouped together. Customers having demographic, age group, income, demographics, they are grouped together. This segment helps to identify the pattern in customer profitability and allows for more targeted strategies. And identify the high value customers. Determine which customers or segment contribute the most to the overall profitability. High volume customers are those who generate significant revenue and contribute positively to the bottom line after considering associated cost. Now, a high volume customers who gives you significant revenue because they produce high volume product, they purchase frequently from, so they give you more revenue and contribute positively to bottom line. After deducting the all types of costs, they contribute positively to the bottom line. And analyze customer behavior. Look beyond revenue and cost to analyze customer behavior. Consider the factors such as purchase frequency, order size, product preferences. Understanding how customers interact with business can provide insight into their long-term value. Consider customer acquisition cost. Factor in cost associated with acquiring and retaining customers. Sometimes high-value customers may require more investment in marketing or personalized services, but this investment can be justified if leads to sustained profitability. Customer lifetime value. Calculate the customer lifetime value, which estimate the total value a customer is expecting to bring to the business over the entire relationship. This metric is valuable for understanding the long-term impact of different customer segments. Now, strategic decision making. Use the insight gained from customer profit analysis to make strategic decisions. This may include adjusting marketing strategies, customizing the services for high-value customers, and revaluing the approach to less profitable customer segment. Then regularly review and update the customer profit analysis as business conditions change, customer preferences, market dynamics, cost structures can evolve, requiring businesses to adopt their strategies accordingly. Customer profit analysis is a valuable tool for businesses to prioritize their efforts, allocate resources efficiently, and enhance overall customer satisfaction. By understanding the profitability of the individual customers, companies can tailor their approach to customer management for sustainable growth. How lucrative is the customer compared to another is one of the core issues that traditional accounting systems struggle with. Customer profitability is usually measured at the gross profit level. Customer profitability is net sales revenue generated by the customer in a given period minus the cost of goods sold, purchase, product mix. However, numerous other expenditures must be considered before true profitability of a single customer can be determined. Yes. How? Now, as I already told you in my beginning, that traditional accounting system suffer lot of, say, they depend on balance sheet and their, say, account statement, but they fail to judge how lucrative the customers compared to another. So generally, customer profitability is a matrix, is an indicator to see how a true profitability of a single customer. Then that can be measured as net sales revenue, how much revenue they have generated in a given period minus the cost of the goods sold. Customer profitability study depicts a group of customers who are not worth serving or who, in other words, are not profitable. The primary notion of the customer profitability analysis is based on discovering the cost-cutting opportunity, avoidable cost concept. If only good clients are dealt with. Christopher in 19 provide a checklist that should be considered while conducting an analysis. So the main objective of customer profitability analysis is to find out who are the customers who are not worth serving. They are not worth serving, or who are, in other words, not profitable. So in cost cutting measures, we have to see that if in cost cutting measures, only good clients are dealt with and those customers who are not profitable may be sidelined. So in addition, Christopher proposed a model for analyzing customer. This model is depicted. It shows how customer gross contribution is calculated by deducting discounts, direct expenses, attributable to indirect cost and other charges from order gross sales value. Any additional customer related expenses such as trade credit, returns and so on are deducted to arrive at a net contribution to the overall profitability. Customer profitability analysis helps in identifying profitable and non-profitable customers, which in turn help managers to devise strategies for dealing with customers who have high service expenses. Another way to receive some generalized directions for strategic decisions to use a customer profitability mix. The basic goal of all these approaches is to create an accounting system that collects data on customer profitability on regular basis. So, customer profitability helps in profitable and non-profitable customers, and which helps the managers to devise strategies for dealing with customers who have high service expenses. Yes. Then direct product profitability is a financial metric used by the businesses to assess the profitability of individual product. It involves analyzing the revenue generated by a product against the direct costs associated with producing, marketing, and selling that specific product. The goal of the direct product profitability analysis is to provide insight into which products contribute more significant to the company's overall profit and which need further evaluation and adjustment. Here, we also discuss the key components. So, DPP or direct product profitability is a financial matrix used by the business to assess the profitability. Now, a company or a business has a lot of product mix, and some products say give more revenue and some products. Suppose I give an example, say in Maruti, Alto was the highest sold car, or if you go to Hyundai, the Creta is the lowest. So the SUVs are the highest sales vehicles compared to the say other segments of the cars. So it involves analyzing revenue generated by the product against the direct cost. The goal of direct product profitability provide which products contribute more significant to the company's overall product, and which further there we can adjust our cost cutting. Determine the total revenue generated by a specific product. This includes sales volume, unit price, additional revenue streams associated with this product. So, identify and allocate all direct costs associated with the production and sale of this product. Direct costs may include cost of goods sold, expenses directly tied to the production of the product, such as raw materials, labor, and manufacturing overhead. Marketing cost, costs related to promoting and advertising the product. Distribution cost, expenses associated with getting the product to the customers and including shipping and logistics. And subtract the total direct cost from the product's revenue to calculate the gross profit. Gross profit represents the amount of money remaining after covering the direct cost of the product of producing and selling the product. So gross profit we calculate revenue minus the direct cost. Then calculate the gross profit margin. Gross profit as a percentage of the product's revenue. To calculate the gross profit margin is gross profit divided by the revenue multiplied with hundreds gives you the gross profit margin. Analyze, evaluate the gross profit and gross profit margin of each product in the product portfolio. Compare these matrices to identify high profit products and those they may be less profitable. So there are a lot of say first we have to calculate the gross profit, revenue minus the direct cost. Then we have to calculate the gross profit margin. Gross profit divided by revenue multiplied with 100 gives you the gross profit margin, and this evaluate the gross profit and gross profit margin for each of the product in the product portfolio. and compare these matrices to identify high profit products and those may be less profitable. Consider the segmenting the product based on the categories, product lines and other relevant criteria. The segments allows for a say regular analysis and helps in identifying the trends or patterns. Then use this insight gained from the direct product profitability analysis to make informed strategic decisions. This may involve adjusting pricing strategy, optimizing production process, or reallocating resources to focus on more profitable products. Regularly review and update direct product profitability analysis as a market conditions, cost and customer preferences evolve. This ongoing monitoring ensures that company can adapt to changes and maintain a profitable product portfolio. Direct product portfolio analysis is a valuable tool for businesses seeking to optimize their product mix and overall financial performance. By understanding the direct cost and profitability of each product, company can make more informed decisions about resource allocation, marketing strategies, and product development. Product direct product profitability is a technique of logistic cost analysis corresponding to particularly retail industry. Just as customer profitability analysis, DPP aims to identify all costs related to a product or order as it moves through distribution channels. Often the total cost of ownership becomes so substantial that it reduces or sometimes eliminates the net profit of an item. Therefore, DPP is important for distributors and retailers in order to influence it favorably and become a low-cost supplier as well as reduce customer cost of ownership. Then there are different sales minus the cost of goods sold. It gives you the gross margin plus allowances and discounts minus it gives you the adjusted gross margin. From here we deduct the warehouse cost, labor cost, occupancy, inventory, transportation cost, retail and stocking labor, front, all this cost. This gives you the direct product profitabilities. So this is how the direct product profitability is calculated. So we have discussed again, there is a few more time is left. Again, we will see which are the important. First thing I discuss is ABC analysis or activity based costing. Activity cost costing is a methodology that allocates the resources to specific activity based on their actual consumption and resources. So it provides more accurate reflection of the true cost of products and services. Then there are different steps, there are different primary activities. Then important thing is I have discussed, again I am in a gist I am saying customer profit analysis, where in a customer profit analysis the customers are segmented or categorized on the basis of their profitability to the organizations. What is the financial impact of each of these customers on the company's overall profitability? There are certain customers who provide more profits to the organization, and there are certain customers who give less profit to the customers. Then there is a procedures which we do this. We generally gather data and allocate the cost, assign both direct and indirect cost. We gather data about the sales volume, transportation frequency, pricing structure. Then we calculate customer profitabilities. Also, we segment the customers accordingly. Then we take certain decisions. Then another concept is very important is direct product profitabilities. That means a company has lot of products to produce, but more there are certain products which gives more profit to the organizations, and there are certain products which give less, say, profit to the organizations. Therefore, is a metric to use by business to assess the profitabilities. It involves analyzing the revenue generated by a product against the direct cost. The goal of direct product is to provide insight into which product contribute more significant to the company's overall profit and which may need further evaluations. Now, to say that, we have to calculate the revenue, total revenue by then from the revenue, we identify and allocate all direct costs associated with the production and sales of the product. Direct goods, I've already told you, there's cost of goods sold, marketing cost, and distribution cost. Expenses directly related to the production of such as raw materials, labor, and manufacturing overheads. Costs related to promoting and advertising the product. Distribution cost associated with getting the product to the customer and including. So then calculate the gross profit. Gross profit is calculated revenue minus direct cost, and from this we calculate the gross profit margin, and finally we evaluate the gross profit margin and gross profit for each of the product portfolio and compare these matrices and consider the segmenting the product based on the categories, product lines, and other relevant criteria. And this segmentation allows for a more regular analysis. So, basis of this DPP, the company use this insight, say, inform strategic decision, long-term decision regarding the pricing, decision regarding the optimizing the production process, and decision regarding the reallocating the resources, and regularly review and update the direct product profitability analysis as a market cost. So, direct product profitability analysis is a valuable tool for businesses seeking to optimize their product mix. That means they should not go for a large number of products in their mix. They should choose those products, optimize their product mix so that their profitability can be increased, and that by they can reduce their overall cost of production. So, is a technique and corresponding particular retail industry, just as customer profitability analysis, DPP is identify all costs the product and order as it moves through distribution channel. So, how you calculate the direct product profitability, I have given you the example. So, logistic cost refers to finally, logistics cost refers to any expenses incurred by any business management to logistics. And knowing how to reduce this is a key challenge to the organizations. And if you reduce our cost properly, this gives you more competitive position in the market. Logistic cost also include expenses related to, as I told, resource acquisition, product distribution, and other expenses. And logistic cost also led to good management of the logistic go beyond making the product reach to the customers. It includes decision making, how to use the financial resources best, and of course in the optimum manner. Thank you very much.